Hi, I'm John Persinos, Editorial Director of Investing Daily. With me today is my colleague, Robert Rapier. Robert is Chief Investment Strategist of Utility Forecaster, Rapier's Income Accelerator, and Income Forecaster. Robert's an expert on income. He's an expert on energy investments, and well, he's something of a polymath. He has degrees in chemical engineering, in engineering, and in mathematics. So I'm glad he could carve out some time to be with us today. Robert, welcome.
Thanks for having me on, John.
Yeah, my pleasure. Let's get right to it. The Israeli-Hamas war has disrupted energy markets, which had already been disrupted by the Russia-Ukraine war. Uh, Investors are worried about the supply disruptions, and also OPEC Plus is adhering to its pretty strict production curbs. With tight supplies and worries about geopolitics, the price of crude oil has been soaring, not surprisingly. What is your prognosis for the per barrel price of oil as we head into 2024?
Okay, so there's a lot to unpack there. So the Israel-Hamas war, the concern there is that it spills over, especially into Iran, which is a major oil producer. So in a tight market, and we have a tight market, and we've had a tight market for a few years. In a tight market like this, anytime there's disruptions around the Middle East, the markets get very, very nervous. So it's not that Israel produces much oil. There's not a lot of oil right there in that immediate vicinity. There's some natural gas, but not a lot of oil. But the real worry there for the market is Iran gets involved, and that impacts their production. Now, if Saudi Arabia and Russia, OPEC plus, I mean, they're the key members there. If they decide they want oil to go to $100 a barrel, then that's where it will go, because there's really not any excess capacity in the market. And I fear that going into an election year where I think Putin would rather work with Trump, and I think Saudi Arabia would rather work with Trump, they hold a lot of cards here on causing some pain at the pump for U.S. consumers. And I fear they may actually exercise that. Now, we had a tool for combating some of that. We got a strategic petroleum reserve. And I always say the high oil prices are not an emergency, but historically, politicians have always looked at that as a tool to try to mitigate gasoline prices headed into an election. The problem is the strategic petroleum reserve was largely depleted last year, or over the last couple of years after Russia invaded Ukraine and oil prices spiked up. Biden used that to help mitigate oil prices, and it did, but at the expense of that strategic petroleum reserve. And I like to tell people the irony here is the U.S. is going to set a new oil production record this year, but we're just not growing production fast enough to offset global growth, and so we're not in a position to make up for any cuts that Russia or Saudi Arabia might make.
Yeah, you're exactly right about the geopolitical chess playing the House of Saud and Vladimir Putin, president of Russia. Of course, they want to keep oil prices high to maximize revenue. That's job one. But they also want to punish the West for what they perceive as hypocrisy on human rights. And they'd rather not see Biden in the White House. Within this backdrop, which energy investments appear the most appealing to you right now? Which subsectors of the energy, oil and gas industries look really like buying opportunities?
So, if my hypothesis is right here, and they do try to drive prices up, then the oil producers, the pure oil and gas producers, will do very well. And my long-term favorite there is my former employer, ConocoPhillips. They have done very, very well over the years. I think they're the best, or at least one of the best managed pure oil and gas producers in the business. If you go to an integrated super major, Chevron is my long-term favorite. I just saw a blip earlier this morning that they are going to acquire Hess. That's a pretty big bite. I know investors don't like it when companies buy other companies, so I'm guessing that Chevron might have dipped on the news. So it might be an opportunity to pick them up. But if you want a little less risk, go midstream. I mean, it should do okay whether oil prices are up or down. Enterprise Products Partners has been an 8% yielder there for many, many years. They've got the cash flow to support the distribution. And then in the refining space, I like Valero. I've always liked Valero. It's done very well for me over the years.
Yeah, the Hess deal reflects how the super majors are looking for a easier found deposits to maximize shareholder returns. Wouldn't that be your interpretation?
Right. I've done that analysis before. I actually made a case a few years ago for ExxonMobil or Shell to buy BP because BP's reserves were only like $8 or $10 a barrel. And it's costing more than that for ExxonMobil to go out and find new oil. So you could get BP's reserves for less than what it costs you to go get news and get the rest of the business for free. Of course, Exxon requiring BP, there'd be all kinds of issues there with regulators, and they probably wouldn't let it go through, but it would be an attractive option. ConocoPhillips would be a very big bite for a super major, but not one that couldn't be done. And if I was a super major, I'd be looking at ConocoPhillips. I'd be looking at some of the some of the smaller oil and gas producers. Devon, maybe not like outside of ConocoPhillips. ConocoPhillips is a big dog there, but there are a few there that will probably get gobbled up in the next few years.
Mm-hmm. There's been a big push for renewables, obviously, but oil will remain the world's most valuable commodity into the foreseeable future. Renewables aren't about to make oil and gas obsolete in our lifetimes. However, renewables are in the ascendancy. There have been a lot of government incentives to make the conversion to renewables. When it comes to solar and wind and geothermal, what are some of the most appealing investment plays that you see?
So, renewables got off to a great start this year, and over the past 5 or 6 years, renewable companies have done very, very well, especially solar companies. There are a number of solar companies that have been 10 baggers over the last 5 years. Now, this year they got off to a good start, but now they've started to undergo a serious correction, and that is a result of high interest rates and some companies coming out and warning that the high interest rates were going to start to impact their ability to grow. And in this very nervous market, that freaked investors out. And so there have been some major sell-offs in some of the big renewable energy plays. Some of them have shed 50% of their value since just the summer. Now, in the long run, they're still the place to be, I think. They got a long, long way to go to really make a big dent in our oil demand, but the growth rates are still going to be at double digits as far as the eye can see. So it's a good place to be. You're getting on a dip right now. The bad news is it's probably going to be you're probably a year or two of a down cycle now with those companies because of the higher interest rates. Now, when we start to see interest rates come back down, I think those companies will start to get footing and they'll start to raise their growth prospects again, and that's when that investment would pay off.
On a related note, do you see the bloom coming off the rose in the electric vehicle market, EVs? It's been a booming segment, and it faces bright long-term prospects. But look at Tesla's recent results; it missed on the top and bottom lines. The stock tanked, and Elon Musk, the CEO, warned that higher interest rates are disincentivizing consumers from buying new cars, and also, people who are adherents of renewables. Everyone wants to see a greener future, but they sort of underestimated the cost and the time it would take to convert to renewables. For instance, a lot of raw materials necessary for electric vehicles, for renewables, lithium, cobalt, they're increasingly scarce. So, do you see some downsides to the EV market in 2024?
Yeah, I mean, sort of the same dynamics are affecting the EV market. Higher interest rates, commodity prices that are volatile and very high, and that's impacting companies like Tesla. But Tesla has another problem, and I wrote about it for Forbes last year, and that's that I think Elon Musk, with his purchase of Twitter and the subsequent decisions he's made, has alienated a lot of people who would have been Tesla customers. And I say this with no political implications at all. Just the fact is, he has elevated a lot of people who that have really angered exactly the sort of people that would be his customers. And I've seen many, many people say, "Hey, I was in the market for a Tesla. I'm not going to buy one now." And I think in the long run, I think Elon has kind of shown himself really who he is to these people. And I see this hurting their market in the long run. Now, in the short run, consumers still don't have a lot of choice. If they want to buy an electric vehicle, Tesla's still the big dog there. But over time, I think some of Musk's decisions outside of Tesla are going to hurt Tesla in the long run.
Yeah, I agree, and he's also been distracted by his colossal mismanagement of X, the former Twitter, and he has alienated the very constituency that'd be in the market for Teslas, sort of the Volvo Chablis drinking crowd. They want nothing to do with Elon Musk. More expensive oil is a boon for energy investors, of course, but it's inflationary. Renewed fears of inflation have been driving bond yields higher, which tends to hurt income stocks. Utility stocks, that's your forte, are getting clobbered by rising yields because they must compete with safer high yield bonds. Higher interest rates also make debt more expensive for utilities, which, as we know, are capital intensive. What's your advice, Robert, for struggling utility investors?
So I always try to remind investors that regardless of the sector, you're going to have a significantly down year. In 2008, during that bear market, the utility sector was down 30% or so. And you don't really expect that from a low volatility sector, but it happens. And it doesn't happen often, but it does happen. And that's one reason I recommend that people, even income investors, don't overly concentrate in any one sector. But if you are an income investor, you're probably going to have your bets spread out in several sectors that have gotten clobbered by interest rates. And so even for income investors, I'd advise, you have a little bit in energy stocks. Energy has done very, very well. The last quarter, utilities got clobbered, but energy was the only sector that turned in double-digit gains. And that's why we've generally been able to outperform the market, even though utility sectors have gotten clobbered, because the energy sector is helping lift us up. But what I would say to those utility investors, look at the long term. As long as interest rates are high, you're going to be fighting headwinds. But I think interest rates are peaking, and we're going to see them start to head back down. And when that happens, utilities are going to rebound. And so I know it's been painful. People get into utilities because they think, oh, low volatility sector, I'm at retirement. This is what I need. And then you see a big sell off like this. It's very unpleasant, but it does happen. And history says it will happen again.
Yeah, the Fed is nearing the end of its tightening cycle. That much is clear. And most analysts expect the Fed to cut rates in 2024 as the lagging effects of higher interest rates start to make themselves felt in the broader economy. And history shows that when the Fed pivots, when the Fed goes from hawkish to dovish, stocks soar in the immediate wake of that policy change. So which asset classes, which stocks specifically do you expect to get the biggest boost when the Fed starts to cut sometime in 2024, probably mid-2024?
Yeah, so I think we will see those defensive stocks that have gotten so battered this year, particularly utilities and REITs. I think those will be the biggest beneficiaries. Anything that's interest rate sensitive has gotten just beaten down this year. And so investors are looking for a sign that, the Fed has stopped cutting and is about to start reducing rates. The irony of this whole situation, I think, is the reason we've had such high inflation is because of high energy prices, and higher interest rates don't really impact that. And so I think the Fed, I disagree with the aggressiveness of the Fed's interest rate increases over the past couple of years, because I don't think it gets to the root of the problem, but it makes it look like they're trying to do something.
That's exactly right. Speaking of the Fed, it looks as if the much coveted economic soft landing is within our grasp. It's not often that the Fed gets things right. In fact, it usually undershoots or overshoots. But at first, in the beginning of the year, there was a fear of recession. Recession fears were rampant. And then as the year wore on, analysts got more and more optimistic and felt that a soft landing was possible. But then the Israeli-Hamas war happened. It's spreading throughout the Middle East. The Russia-Ukraine war is getting bloodier with each passing day. Do you think now that the soft landing scenario is too optimistic?
Yeah, so it's funny. I posted two headlines from Bloomberg a few days ago, and they were 1 year apart. And 1 year ago, the headline was recession risk rises to 100% in the next 12 months, say analysts. And then the 1 year later, it was soft landing looks doable, or something like that. Economy stronger than forecast. And so there are a lot of strong economic signs, and job market remains good. Consumer spending is holding up. It looks like we could achieve a soft landing, but there is still risk. There's still a risk, I think, of a mild recession next year. But companies are hanging in there, and we may see a recession in some sectors and not across the board. But overall, there's a disconnect, I think, between how a consumer feels, and I deal with people all the time, and they feel like the economy is not good, and then we have these economic indicators that say no, the economy is pretty well. And I say that's because basically what consumers, how they view the economy is how much is gasoline costing me and how much are groceries costing me, how much is my rent, and not really, they're not looking at, oh, the jobs market is really strong and wages are up. They're not looking at those things. They're looking at how am I being impacted on a day-to-day basis, and that's how they view whether the economy is doing well or not.
Yeah, and let's not underestimate how partisan media outlets trash talk the economy, and some people are steady consumers of that, and they come away with the impression the economy is in the toilet when that's divorced from reality. But also their personal experiences matter. The price of eggs, the price of gasoline. Let's shift to sector investing, sector rotation. Among the 11 S&P 500 sectors, which ones do you expect to perform the best in 2024?
I think it very much depends on if the Fed makes a rate cut early in the year. I think that's unlikely, but if they do, we could see the utility sector rise back to the top after being, one of the worst performers this year. Now, the other factor is the energy, my energy hypothesis that Saudi and Russia will actually try to engineer higher oil prices. And if that's the case, we could see the energy sector back on top next year. I predicted this year that we'd see a pullback in the energy sector and that it would not be the top performer after it was the top performer the previous 2 years. If we see persistently high oil prices, even oil prices where they are right now, the energy sector could be back on top. It won't be on top this year, but it could be back up there next year.
And which sectors do you think will perform the worst in 2024?
I think technology has gotten ahead of itself. If we see an interest rate cut, I think every sector will be positive for the year. But I think technology got a little bit ahead of itself after the sell-off last year. And so we could see a pullback in technology. And we did see technology underperform in the third quarter. And so, technology could be down next year if we see that rate cut.
Robert, that was very informative, very useful. Thanks so much. Have a great day.
Thanks, John.
You've just heard from Robert Rapier, income expert who's chief investment strategist of our premium trading publication, Utility Forecaster. For details about the latest opportunities unearthed by Utility Forecaster, consult the article that accompanies this video on the Investing Daily website and look for the URL at the bottom of that article. This is John Prasinos. Thanks so much for watching.